Hey guys, welcome back to another video. I know it's been a while, and yeah, now my mic sounds better. I'm back home, thankfully, and hopefully you guys can understand me better, and I can make some better content for you guys. So in today's video, I'm gonna be talking about um, the unfortunate event that took place in my portfolio. I took two naked options in Spotify, and they were completely like out of the money. I lost a shit ton of money on the Spotify calls, well, relatively to what I put in. At first, I originally bought some Spotify calls around 180. Then they dropped all the way down to 120, and I bought a second one, hoping to get a nice little um, correction and then try and cash out like break even or something like that. But I got greedy. It got back to a nice mark, and then I continued to hold them until Spotify continued to, lose value. This was a little while ago. It's not that recent, but it was like a couple of weeks ago. So if you can see on my previous history, we can see my orders. So we sold both contracts for Spotify for a total of 114. So essentially, I had to buy each contract back. Well, I bought them back and I got some cash back instead of waiting till expiration and I'll lose all my money. I had to sell each one for $55 each, which was 114 for both of them, which was bad to be honest compared to the original price. This was on the 7th of August, so it was early August. I bought these contracts way more expensive. Like the first contract was 268, the second one was 134, and it really did not help my portfolio at all. To be honest, it was a really retarded decision, but thankfully I did it because I've done some more research and now I'm changing the strategy up. So this is like a short video of why you should give up on naked options and pursue creating contracts instead. So you might be wondering, what are contracts and what do you mean by that? So I watched a couple of videos and I found out about credit spreads, and I have a little nice strategy going. Thankfully, I saw a YouTuber. I don't remember his name, but thank you, bro. Like I saw your videos and they really helped me out, and I started implementing the strategy, and I've grown my portfolio. This is the second week of doing the strategy. I'll hopefully post a new video about the strategy every week. I'm trying to keep track of it. I'll show you guys the Google Sheets I've created and show you the progress and how much profit I've made relatively to my portfolio. So right now my portfolio is sitting at 3.8. I'm not including my Roth IRA, so around everything's like 5k ish. Yeah. Um, I'm still up in most of my positions right now. The only one that's currently down would be Virgin Galactic. Right now I'm currently down $76, but everything else is pretty green because I bought it a while back. My largest position is Riot Platforms. I'm still up 103%, which is insane, but it was higher previously today. So cover credit spreads. So credit spreads is the same thing as covered calls, but instead of having enough money to own 100 shares of the underlying stock, you only need to have the difference in strike prices. So you might be wondering, what do you mean the difference in strike prices? So the strategy I'm currently using utilizes SPY. The reason why is because SPY has 3 trading days in a week, which is insane compared to other stocks or ETFs. It usually takes a week or it's like once a month, so it's like very slow. But thankfully, SPY you can do one pretty much Monday, Wednesday, and Friday, which can maximize gains pretty intensely. So right now you choose strike price, and let's see strike price. Okay, so SPY, if we had 100 shares, we would need $44,000 for 100 shares, and no normal person, that's trying to build their portfolio has 44k unless you get a bonus or unless you're already wealthy in that sense. But if you don't have this type of money, credit spreads are the way. Like credit spreads can boost your portfolio really far and gone. Like it's a very powerful option strategy and it's safer than naked options. The only downside is it is capped gains. So what I'm currently doing is I'm selling covered credit spreads, right? So for credit spreads, is the opposite. So when you sell a put, you think the stock is going to go up, and when you sell a call, you think it's going to go down since you're creating the contracts. So it's a simple explanation like that. So like for example, SPY is trading at $448. For my credit spread, I would want to go a little down. I think SPY is going to keep going up because it's been down for the past 2 days, and usually the S&P is green. So I'm going to do a strike price of, let's do $44, and then you would buy a put above it or under it, my bad, you would sell a put and then you buy one under it, slightly lower. So your strike price is 4.44 and the difference is $1. So this contract would cost you $1 times 100 is $100. So $100, and you would get instantly a credit of $12. And to many of you, you're like, yo, $12 for $100? That's pretty garbage if you ask me. If you think about it, it's a 12% return on this investment that most likely will end up in the green. It's in 2 days, so it's super quick. If you can do this 3 times in a week, think about it. You can generate 30% returns in fucking a week. So that's pretty impressive. So, and if you have plenty of this, you can do it with more than one, and you can make a nice chunk of cash weekly, and you keep growing this. The YouTuber I was watching, I'll mention him in the comments, or not in the comments, in the description under the video. I really forgot your name, bro. I'm really sorry, but I'll plug you in because honestly, this is your strategy, and thankfully, I'm trying to see if I can work it out and hopefully hone it to a degree. So in his video, he was saying that what he does is he finds the strike prices and he makes sure the sell put has a delta of usually within 1.15 or 0.15. This one is currently at 0.18. It's a little risky, but what this means is that there's an 18% chance this order might give, like, you know, it might be profitable for one of the legs. So, you know, you have a 92 or 82% chance of this being in the, like, getting your credit. You always get your credit, but there's an 82% chance you win, and then there's a 16% chance you might not win, or 18. I forgot the delta, what it was. So I think it's sell put. Yeah, the delta's 0.18. It's still really good. It's still not at 20%. And as time passes, it'll, you know, get lower. As of right now, what I'm currently doing, since it has 2-day expiration, I hold it, wait till the next day, market open, and usually 75% of the value, if the stock is like sideways or going towards the direction you want it, it's usually 75% filled already. So I buy the option back and don't make my full amount, but that way I'm securing profits. So I'm not trying to get greedy. I'm just trying to secure profits and rinse and repeat. And so far it's working. So you would get $12 credit if SPY doesn't drop from $443.87. That's your break even. So anything above that is fine, as you can see, all the way to 454. But if it does go under the strike price, which would be $44, you would lose $87. The reason why it's $87 and not $100 is because you're getting a credit, so it's taking it out of that loss. You would instantly get the credit. You can use the credit for anything you want. You can buy other shares, you can do other option contracts, you can buy Chipotle, you can do whatever you want. So that's the benefits of credit spreads. And then again, you can just do the opposite. You can do a call if you think SPY is going to go down in that period of time. The reason why I like SPY is pretty stable. It moves around a little bit, but you can kind of predict where it's going depending on news, or simply like the big stocks such as Apple, Tesla, Microsoft, Amazon, Google. You know, they're kind of, you look at them, if they're green, you can kind of tell where the SPY is going to head because they own majority of the percentage. So let's exit out of here and show you the spreadsheet. You can probably see the spreadsheet right now, and you might be wondering, you're a little confused. So I started this strategy about a week ago, and I've done around 1, 2, 3, 4, 5, 6, 7, 8. I've done 8 different option contracts, some of them being covered calls because I own 100 shares, and other of them being credit spreads. So with a combination of covered calls and credit spreads, I got the chance to make $77 the first week. Considering it, that's a good frame of reference. It should be 10% of your portfolio if you're trying to grow it aggressively. 10%, some of you might think it's a lot, some of you might think it's not a lot. It just depends on the person. Me personally, I'm just trying to start off with 10% and maybe grow as I get more comfortable with it. Maybe I'll do more secure credit spreads with like a 0.08 delta or something less than 10%, but we'll see. So this week, week 2, I'm up $24. Yesterday I closed 2 SPY contracts, if we can find them, for $5, I believe, or right here, $6 SPY. I did a call credit spread right here, and then I closed it for $6 and I made $20 profit. So 10% of my risk. It was $200 because 100 for each contract, and 20%, $20 gain, just 10%, gain. So yeah, so we're up $24 right now. We did another SPY contract, but since we gained more money from the previous week, we added an additional contract. So now we have 3 SPY put credit spreads. And yeah, so this is $32 of premium. Hopefully we're trying to beat week 1, and yeah, and hopefully every week we can grow it, and then every month it'll be larger and larger profit. In terms of portfolio, at the end of market last week on Friday, my account value was 3,971, and then with the profit accumulated from week 1, we made 1.9% returns on the portfolio, which is not bad at all for 1 week, and it was solely based off of options. It wasn't stock growth, it wasn't anything like that, it wasn't dividends, it was just simply option plays. So yeah, we'll see what happens. So as of right now, we have accumulated $101 of premiums just based on a week and 2 days, or simply 1 day because it's today's Monday. So that's pretty good. The best thing about credit spreads, you can close out of them. It's fairly simple to do. You don't have to keep it till expiration. I suggest you make sure you have a day before expiration because it can get tricky. Like as of right now, for example, my 3 put credit spreads, I did them after market close. So essentially, market was open, I went to the gym, checked on my phone, it was around 11, 12, and then they were going for around $10 or $11. I bought 2 for $11, then I bought an additional one for $10 credit. In total, 32, right? 11 was 22 plus 10, 32. And as you can already see, after market close, this lost most of its value, so that's good because it's data gang. You're getting money based on depreciation, and if I get to close this, I can make a bunch of profit. Like I'm already up 80% of this, so each contract's trading at $4 right now. If I close this, I would make an additional $20, so I'm 62% return on investment. To be honest, this is a super simple strategy. Again, you need level 3 access for this strategy in particular, and yeah, we'll see how it goes. I'll make sure to display the Spotify calls and all that and at the start of the video while I'm editing. But thank you guys, and I hope you enjoyed this video, and hope you guys make some money in the markets, and take care, and I'll see you.